Good early morning, everyone. T-Speaker 222 XRP Future Millionaire with the side bet on XM and Future Digibyte OG. Well, actually, it's 3:42 a.m. for everybody watching this right now. Today, instead of going into something new, we're going to cover the gold, the commodities, and the breaking news that happened today that could cause a sudden crash. Well, not a crash, but what you've seen, a sudden sell-off in the gold and silver, the commodities market. As I told you guys, about 48 hours ago, about 38 hours ago now, I told you to watch for a sell-off. Unfortunately, not very many people watched that video, but not very many people watched this overnight radio show, which is fine. This is just going to be a wider spanning show, so we're just going to cover basically anything. I'm just going to name it the overnight radio show, and anybody who wants to watch can watch. We'll go over what we go over. We'll shoot the shit, and then I'll be out. So what I want to do first is go over this list. The Dow Jones is down 265.66 so far at 34,033. The U.S. dollar index is down 0.1% to 91.38, 91.386. So it's got a lost handle on 91.5. I'm assuming it's going to go down pretty relatively quickly here. Crude oil is dead even at 71.25. Gold is rebounded a little bit. It was off. It was down about $42 yesterday, but it's up $8.21 to $18.19 so far. Platinum's up $8.33 to $11.26.85. Silver's up 20 cents to $27.12. But guys, this doesn't tell the story. You guys see the numbers are way down. There was a nice 4, 5, 6 to 7% retrace, and now it's picking up some of this back. So what happened is the Fed came out and said that they're not worried about interest rate or worried about inflation, and that it's not transitory, which is all horseshit. So basically, interest rates are going to go out the ass. They don't care about stopping interest rates from going up because they don't think it's an issue. So as the interest rates keep going up, cost of our foods, cost of our commodities, cost of everyday living goes up, and we've got a big mess on our hands. So let's continue down the list. B2 Gold was down 3 cents to $4.84. Kinross was down 55 cents and got absolutely hammered, down 7.18% to $7.11. Yamana Gold was down 2.19% to $4.91. Hecla Mining is down 1.13% to $8.77. AU was down 1.92% to $51.63. GPL was up 0.39% to $69.60. RDSA was down 1.63%, and this is your foreign stocks and oils, so we can get off the U.S. exchange. And then VOD was down 1.65% to $18.51. They all pay, both of those pay a 5.5 plus dividend. So basically, the biggest news that we're going to discuss today is how this kind of news, why would gold be affected with the inflation, with the impending inflation, with the news that came out today, with the cost of interest rates we know are going to keep going up, and they've already gone up. We can cover this on a different, a different episode, but the 10 years already going up. Everything's going up. So why would gold initially sell off? Well, what happens, guys, is for some reason, once the fears of inflation are realized, and they realize, hey, this stagflation is real, and this is some real shit. This is transitory. They think it's not transitory. They think this is just going to fix itself. They think everybody's going to come back to work, and all of a sudden everything's going to be back to normal, and everything's going to work itself out. But the problem is the difference in the budget isn't because people aren't working. We're not making the products in the United States anymore. That's the problem. We're getting money we haven't earned from the government. We're buying products we can't afford or that we don't make. So what's going to happen? Well, eventually the products that, are left on the shelves here are going to cost more. There's less products being shipped in from the shipping containers. So as long as it takes for those cargo ships to get over to the States, well, there's another fee. Well, now you're cluster fucking everything, and we don't make any products here. So, this isn't just an overnight thing. This is transitory. This is going to happen And it's not going to go away and solve itself like the government thinks it's going to, or the Fed thinks it's going to. It's an absolute joke at this point. So, yeah. But, so it's going to be a big nightmare. So what ended up happening is always what happens is, for whatever reason, the gold and silver markets always overreact. People always sell out of their gold and silver. And what do they do with that? They sell out of their gold and silver to buy stocks, to buy crypto, to buy Bitcoin. It makes absolutely no sense. They buy those because they think that they're going to make more money because gold and silver is suddenly going to collapse with this news, when they should realize that what's actually going to collapse is the U.S. stock market and the crypto markets. You know, that's what's going to really collapse. Gold and silver, you should be buying more. Decade over decade, it is the only asset that increases intrinsically and doesn't have to worry about inflation. Look what happens to the housing market when inflation runs rampant. If your house is worth $400,000 a day and inflation's at an all-time high and no one's got any money, well, your house gets cut in half. Just look at what happened in 2008. The house I live in right now was $95,000 in 2008 when the market crashed. Now we fast forward 13 years later and it's worth $216,000. So that makes a big fucking difference. Now if we crash again, this house will probably be worth $120, $150. You know, that's what I'm saying though. It's all a number. So the gold and silver markets sell off. People use their profits. They sell their physical metals, which makes absolutely no sense. And they just sell off. They sell it off. And then they put it in other parts and segments of the market. And then they end up losing all that. And then they don't even have the gold and silver they had before. And then when that starts skyrocketing, then they're really fucked. And that's when people really lose it. And like, you know what? This is all fucking horseshit. And I understand that. But there is one other thing that I want to talk about. Hold on, guys. Let me go to the mobile site. No, we don't want fucking the township. We got to go to the Wyckoff distribution, but... So, a lot of people ask me about this, and they want to know what this trading method is. So, I'm going to go through the info. So, you guys... I'm going to go to Google, though. But I'm going to go to Google. We're going to go through the Wyckoff distribution. And I'm going to let you guys know what this is. Because a lot of people in my community base their stuff off the Wyckoff method. So... The Wyckoff method is a technical analysis approach to navigating the financial markets based on the study of the relationship between demand and supply forces. Wyckoff based the approach on his observations of the market activities of a group of better informed, more highly experienced traders and investors. So, a lot of people talk about the... So, here, we'll just go through this. Identifying significant trading ranges that have high probability of being accumulating phases, enter long positions before the main thrust of the markup phase. Take profits in long positions at the distribution top. So what happens? So here you go. The Wyckoff accumulation. The accumulation phase is a sideways and range-bound period that occurs after a prolonged downtrend. This is the area where larger players try to build positions and shake out smaller fish without causing much of a further drop in price or the beginning of a new trend. So... What happens after the Wyckoff pattern? The markdown phase. The markdown is the last stage of the Wyckoff price cycle. The markdown process comes as a downtrend, begins after the distribution phase. The markdown is confirmed when the price action breaks the lower level of the flat range of the horizontal distribution channel on the chart. So then you guys want to know how reliable it is. So based on Wyckoff method to divide the markets into phases A through E, this broke down the pool operating as they cooked the stock. So always ended up buying just before the breakout rather than at the false breakout points or at the dead points in the stock. So it is 90% accurate if you do the work. How do you know if it's accumulation or distribution? The accumulation/distribution indicator, A/D, is a cumulative indicator that uses volume and price to assess whether a stock is being accumulated or distributed. The AD measure seeks to identify divergences between the stock price and the volume flow. This provides insight into how strong a trend is. How do you trade with the Wyckoff method? I'm going to go through all this for you guys because you guys ask me the same questions about it a lot. So the Wyckoff method involves a 5-step approach to stock selection and trade entry, which can be summarized as the following. 1. Determine the present position and probable future trend of the market. 2. Select stocks in harmony with the trend. 3. Select stocks with a cause that equals or exceeds your minimum objective. So this technical analysis really works. Well, obviously. So Wyckoff's market rating system is based on a scale of 1 to 10, with 1 being the most bearish market rating and 10 being the most bullish market rating. It means the market has likely been in a longer-term downtrend or has seen a quick and powerful down move and is at or near its contract low. So what is spring in Wyckoff? A Wyckoff spring occurs when a market average or stock falls below its trading range and makes a new panic low and then springs back into the previous range. It's a relatively rare situation, one that is usually associated with a sell-off that is a rather apparent description of the entire week's action. So I want to go back into the Wyckoff though, into the Wyckoff distribution, but I want to show you the pattern. So this is how it looks if you're in the Wyckoff distribution pattern. So we start at the left. We got the PSY, the BCARSD. So they're showing you phase A, phase B, phase C, phase D, and then you got phase E. If you're asking me, I think we're going in we're in like a phase D of the Wyckoff. You had phase A where we had the run up. We had a crash down. We went back up and went just slightly higher in phase B. Phase C, we've been pretty much down the middle, and now we're going in the phase C. We went up slightly. I think we're working our way back into phase D. And then in the phase E, as you can see. So I think we've already done A. We've already done B. We've already finishing off C. We're into D. You know, we're moving into D once we get back to 65. And then once we get back to low support, and then we can break out into E. That's how I think it's going. You know, you can look at it like this too when you're going up. But we're clearly not on a reversal pattern from the downside. We're not. We're not on an inverted pattern. We're clearly on this kind of a pattern. And there's not much more that I can say as far as that goes, but... So we can go to the Wyckoff distribution when it comes to crypto. But you guys just seen that piece of paper that I brought out. So that's a live trading of the Wyckoff distribution. If we're going in the trend that we're in right now, and that's why I showed you it. Okay, so the Wyckoff method explained. The Wyckoff method was developed by Richard Wyckoff in the early 1930s. It consists of a series of principles and strategies initially designed for traders and investors. Wyckoff dedicated a significant part of his life teachings, and his work impacts much of modern technical analysis TA. While the Wyckoff method was originally focused on stocks, it is now applied to all sorts of financial markets. A lot of Wyckoff's work was inspired by the trading methods of other successful traders, especially Jesse L. Livermore. Today, Wyckoff is held in the same high regard as other key figures such as Charles H. Dow and Ralph N. Elliott, the Elliott wave theory. Wyckoff did extensive research which led to the creation of several theories and trading techniques. This article gives an overview of his work. The discussion includes blah, blah, blah. Oh, the 3 fundamental laws. Okay, so the 3 laws of Wyckoff. The first law states that prices rise when demand is greater than supply and drop when the opposite is true. This is one of the most basic principles of financial markets and is certainly not exclusive to the Wyckoff's work. We may represent the first law with 3 simple equations. Demand is greater than supply equals price rises. Demand is lower than supply equals price drops. Demand equals supply equals no significant price change, low volatility. In other words, the first Wyckoff law suggests that an excess of demand over supply causes prices to go up because there are more people buying than selling. But in a situation where there is more selling than buying, the supply exceeds the demand, causing the price to drop. Many investors who follow the Wyckoff method compare price action and volume bars as a way to better visualize the relation between supply and demand. This often provides insights into the next market movements, the law of cause and effect. The second law states that the difference between supply and demand are not random. Instead, they come after periods of preparation as a result of specific events. In Wyckoff's terms, a period of accumulation cause eventually leads to an uptrend effect. In contrast, a period of distribution cause eventually results in a downtrend effect. Wyckoff applied a unique charting technique to estimate the potential effects of a cause. In other terms, he created methods of defining trading targets based on the periods of accumulation and distribution. This allowed him to estimate the probable extension of a market trend after breaking out of a consolidation zone or trading range TR. The law of effort versus result. The third Wyckoff law states that the changes in an asset's price are a result of an effort which is represented by the trading volume. If the price action is in harmony with the volume, there is a good chance the trend will continue. But if the volume and price diverge significantly, the market trend is likely to stop or change direction. For instance, imagine that the Bitcoin market starts to consolidate with a very high volume after a long bearish trend. The high volume indicates a big effort, but the sideways movement, low volatility, suggests a small result, so there is a lot of Bitcoins changing hands, but no more significant price drops. Such a situation could indicate that the downtrend may be over and a reversal is near. The composite man. Wyckoff created the idea of the composite man, or the composite operator, as an imaginary identity of the market. He proposed that investors and traders should study the stock market as if a single entity was controlling it. This would make it easier for them to go along the stock market. In essence, the composite man represents the biggest players, markets makers, such as wealthy individuals and institutional investors, that always acts in his own best interest to ensure he can buy low and sell high. The composite man's behavior is the opposite of the majority of retail investors, which Wyckoff often observed losing money, but accordingly to Wyckoff, the composite man uses a somewhat predictable strategy from which investors can learn from. Let's use the composite man concept. So accumulation. The composite man accumulates assets before most investors, so that's why I always say buy before all the fucking buzz comes. This phase is usually marked by a sideways movement. The accumulation is done gradually to avoid the price from changing significantly uptrend. When the composite man is holding enough shares and the selling force is depleted, he starts pushing the market up. Naturally, the emerging trend attracts more investors, causing demand to increase. Note that there might be multiple phases of accumulation during an uptrend. We may call the accumulation phases where the bigger trend stops and consolidates for a while before continuing its upward movement. As a mark, and then I'll do a distribution, and then I'll let you guys out of here. And then if you guys show interest in this, I'll continue on with the Wyckoff. So as the market moves up, other investors are encouraged to buy. Eventually, even the general public becomes excited, though, enough to get involved. At this point, demand is excessively higher than supply, and then distribution. Next, the composite man starts distributing his holdings. He sells his profitable positions to those entering the market at a late stage. Typically, the distribution phase is marked by a sideways movement that absorbs demand until it gets exhausted, and then we have the downtrend. Soon after the distribution phase, the market starts reverting to the downside. In other words, after the composite man is done selling a good amount of his shares, he starts pushing the market down. Eventually, the supply becomes much greater than demand, and the downtrend is established. So, and then we have Bob's bounce. Similar to the uptrend, the downtrend may also distribution phases. These are basically short-term consolidation between big price drops. They may also include dead cat bounces, which I call dead Bob's bounce, or the so-called bull traps, where some buyers get trapped hoping for a trend reversal that doesn't happen. When the bearish trend is finally over, a new accumulation phase begins. And then if you guys want, we'll go on. If I get enough comments where you guys say I want to continue, the next thing we'll cover is the Wyckoff schematics. But if there's not enough interest, I'm not going to waste my time to do this. But if there's even one of you guys that want to hear the next part, I want to hear it in the comments and say, I want you to cover on tomorrow's show, on tomorrow's overnight radio show, I want you to go into the Wyckoff schematics, and I would love to. I want to continue to go through the Wyckoff schematics and continue to go through this, but we're already at 20 minutes. So I want to thank each and every one of you for tuning into the overnight radio show. I started it out a little different because I wanted you guys to understand what was going on and why gold and silver were kind of getting hammered right now. But today was about the Wyckoff accumulation. And just in general, if you guys actually want to do this, just tell me. I want to hear more on a part 2 on tomorrow's overnight radio show, and you want to hear the Wyckoff schematics. I'll save this so that I can have, I'll have more than just this on here, and we'll have a nice long Wyckoff tomorrow. So T-Speaker 222 XRP Future Millionaire with the side bet on XM and Future Digibyte OG. I really enjoy doing these overnight radio shows, and I really appreciate every single one of you tuning in every single day, 7 days a week at 3:42 a.m. If you want to donate to the channel, links in the description. If you want to join Tom's Army, links in the description. And guys, if you would do me a huge favor, like, comment, and most importantly, share this far and wide so we can get more and more people to this overnight radio show and to the channel overall. Thank you guys very much. Be safe going to work. If you're going to bed, sweet dreams, and I'll see you later. And for the rest of you guys, just stay safe and make sure you watch over yourselves and each other, because without each other, life isn't even worth living. So take care of yourself and your neighbors. Stay blessed, guys.